It's been a quiet week for financial markets, but maybe finally now, at the tail end, we are going to get a little bit of action. That's what we're focused here on Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And what we are going to talk about, which really ought to surprise no one that watches the sort of macro flow, if you will, and the macro headlines hitting these markets, is the U.S. jobs report. We're going to get November's numbers here within less than 24 hours. And what we're going to be asking ourselves as we break this down is, first and foremost, should anybody care? That's what really concerns what we've been looking at in these markets this week and really over the past week and a half. Because, of course, the most critical question that really ought to be on our minds, at least as far as I can tell here, is which part of this economic data is going to tell the markets something that they don't yet know? Which part hasn't yet made its way into baseline expectations that have already been factored into asset levels? So that's what we'll attempt to figure out as we go through here. And of course, it begins this conversation with a view of the expectations. And here what we see is we're looking for a little bit of a wiggle higher on the unemployment rate from 4.1%, where it's been for the past several months, up to 4.2%. The headline non-farm payrolls number expected to come in at 200,000 jobs added for the month. That's obviously a significant improvement from the 12,000 from the prior month, which, as we can see here, was a pretty shocking move out of the norm. The preceding bottom here, going all the way back almost 2 years here, is 136K, and so obviously this was quite the deviation. And so as we look at all of this, the real question starts to really crystallize, because it is this weird number right here that begins to tell the story for why this data could be a little bit suspect. Now, when this came out last month, everybody was very quick to write it off and say, okay, weak number, sure, but there were hurricanes that month. There was a massive strike at Boeing. There were a bunch of strikes at hotels around the country. This is a one-off. This is a flash in the pan, weird number. This is not anything to worry about. And indeed, if we look at the stability in the unemployment rate, which comes from a different data survey, incidentally, we get the sense, you know what, this is probably not a big deal. That, of course, makes how this number's data looks that much more interesting, because you would expect a degree of give back. You would expect, indeed, to come back somewhere around 200K to the middle of the recent range, to essentially tell you not much has changed. We had a 1 month deviation around idiosyncratic factors, and now things are going to be back to the previously scheduled programming. That gives the markets one reason, at least, to look at these numbers with a degree of sort of circumspect skepticism. Because whatever happens here, if it's a 200K number, perhaps it'll feel a bit light without revision to the October number to something higher. If the October number is revised to something a little bit more palatable, like let's say something in the tune of 80K, 100K, and then you get a 200K number, well, that's going to seem like business as usual. If you get a number at the headline that looks more like 300K, and the number from October is about the same or even revised a little bit lower, it's going to look like, okay, the 1 month back and forth is essentially here. What's interesting in this context is the flow of U.S. economic data relative to expectations, because much of what we've looked at in financial markets really since late August has followed a narrative that's had U.S. economic data outperforming expectations, and with that outperformance, a sense that the Fed may not be in position to do nearly as much easing as they promised in September. And of course, we've had that on display all around the financial markets, most tellingly, of course, around the situation in yields and the U.S. dollar. And so there is an argument to be had here that with U.S. economic data improving as it has here, you immediately catalyzed a turn higher in the dollar, a turn lower in the bonds, and higher in yields, because the markets basically looked at the Fed and said, yeah, okay, this looks like you're looking backwards, not forwards. You're not going to do all of these cuts. So with that, were this to have been, let's call it 1 month or 2 months back, strikes and hurricanes notwithstanding, of a jobs report, you might be looking for hotter data. But if we look at what's happened here over the past several sessions, and maybe about the past week or so, is the surprise quotient has stopped moving in the right direction. It's actually started to roll over, and in fact has moved through its 20-day moving average. Now, lest you think we're doing technical analysis on an economic indicator, we're not. The 20-day moving average is about a month's worth of days, and there's about a month's worth of economic data in a given cycle. Some data is quarterly, some data is weekly, but most of the actionable economic data that markets look at tends to be monthly data. So it takes about a month for market watchers to go, you know what, maybe we have a situation here where our expectations are wrong. If the data keeps doing this, if it keeps beating relative to forecasts, then plainly the economy is telling us that it's hotter than our forecasts are saying, which means the models that spit out our forecasts are wrong and need to be readjusted. And it takes about a month's time to start to see that and to start to turn the knobs. And so when you get through the 1 month moving average on this, essentially what you're saying is maybe the knob turning has commenced. And what we're seeing here is data starting to get a little bit soggier, if not just finding a level to hold at rather than continuing to expand here. Again, not in absolutes, but in relative to forecast terms. Maybe the momentum behind this is spent. And now we're going to see data at first find some sort of a level to consolidate at, and then maybe correct lower as forecasts are trued up to the actual performance of the economy. There is some evidence that this is starting to occur. For example, focusing, of course, on employment data here, we got the ADP report earlier in the week, and this is not generally a very good predictor of what NFP is going to do, but What's interesting about this is here's a labor report where the markets had benchmarked labor growth at 150K. What they got was 146, right smack on forecasts. If we look at the jobs openings numbers, the JOLTS report earlier this week, again, pretty close. 7.74 million job openings, a little wiggle higher here against expectations of 7.48. Pretty close. So we're looking at the sense that labor market data out of the US is starting to look a bit like it is anchoring to expectations. And that, of course, is fairly good news here, at least if what you're looking for is something that doesn't rock the Fed policy boat. Because, of course, the critical question here for any of this economic data is ostensibly less about what it means for the economy as a driver of corporate earnings and of stocks, and more about what does the economic data mean for a Fed that is trying to fine-tune its rate cut cycle. Does this ultimately jettison anything about the way that the table is set for the central bank? And as it stands, we can see the market is pretty well set up for the Fed to cut one more time in December, the priced in likelihood of that, almost 72% here. And for the rest of the year, that looks to be all of the volatility that's there. Next year, you're looking for 64 basis points in easing. And of course, that improvement in U.S. economic data that we saw right here after the Fed started to cut, the turn in the dollar, the turn in bonds, which you see right here. This is, again, start of September. We can see bonds are turning up here at the front end, the 2-year, and the long end, the 10-year. The dollar is turning up. This is the dollar index here. Inflation expectations baked into the bond market, so-called break-even rates, they're turning up. So the yield curve uninverts. So what you're seeing is a kind of broad-based readjustment in Fed policy expectations with that data improving. Now it's been cut in half in terms of the rate cut expectations that were there before the cut cycle started. Consider you have 233 basis points for this year and next as a sum total here, of which this year is 100 basis points or so. The Fed does 50 of it up front in September, does another one in November, and gives us every indication that October is go time, or that December is go time, rather, despite the fact that it waters down its own dovishness. So here's the statement from November's meeting. We can see here, in particular, as it pertains to the labor market, we can see that job gains were replaced with, since earlier in the year, the labor market conditions have generally eased. So a stronger view here, rather than job gains have slowed, a much more kind of watered down view on how much rate cuts you actually need. And then inflation has made progress rather than further progress. It's nuanced, but of course it reflects the idea that both CPI and PCE haven't seen disinflation for about 4 months now. So we're looking at a Fed that is stepping back from how dovish they were in September. But if we look at the minutes from the very same meeting, what we find is that many participants noted the volatility of recent economic data and highlighted the importance of looking through it, essentially, and focusing on underlying economic trends. And the large majority saw a 25 basis point cut at the December meeting, even as they did this walk back of more dovish rhetoric. And of course, we just heard from Fed Chair Jerome Powell earlier this week. We also heard from him in a speech just a week after this policy meeting. All of it was walking back just how much easing the Fed would do. That, of course, reflects this right here, this cutting in half from 130 basis points, so 230 less the 100 basis points for this year, which the Fed seems to have talked its way into, hence this. That remaining 130 for next year is now half of what it was as the market responds to the better data, to the upshift in inflation expectations, everything that we've just seen. So the question is, okay, the Fed wants to look through economic data. It doesn't want to get stuck on any one given indicator. It is saying that they're not in a hurry. And we seem to be in a place where the numbers are starting to come in closer to expectations. That is to say, they are losing a capacity to perpetually surprise to the upside with greater vigor. And because of the weirdness in the data here, there is already a tendency for markets to look at these numbers with, let us say, less than great conviction and say, whatever comes out here is probably going to get revised. So unless it's some sort of insanity from the moon kind of a surprise, chances are there's nothing for the Fed that's actionable here. All of this seems to set up a jobs report that's more event risk going in the rear view than substance to put into economic models and into a trading strategy and say something has meaningfully changed. Because there's not a whole lot of confidence in looking at these numbers seemingly and saying they mean a whole lot. They already are seemingly likely to come in close to as expected. And the Fed has essentially admonished us now repeatedly through the policy statement and the minutes and the speeches not to get overly stuck on a single number. Does that mean that we're not going to get any price action then? Well, no. Let's go back to this chart right here. What have we seen since basically the second half of November going into December? The dollar has pulled back. Yields have pulled back. Inflation expectations have, if we want to be generous, anchored, but really have come off the highs, but for the past day or two. And so what we have is a sort of distribution of speculative interest in what has been a near 3-month story out of the market because we've essentially run out of fresh fodder to feed the fire. We have a situation where we have basically until the Fed's December meeting, after which the markets are probably going to feel themselves safe to go to sleep for the rest of the year until we show up in January. And so if you've been an opportunistic trader that's been looking to take advantage of this move, incidentally, as I have, being long dollars primarily and long the bonds as well through this move, positions that I've since flipped over, you have a sense that, you know what, you've had a good move. There's probably not much change that's coming, given what the Fed has told us about their relationship with volatility in economic data and with the fact that the election is out of the way and won't see any actionable fresh fodder until policy starts to actually occur, which is a story for next year. And so perhaps there is room for people that may yet still be in these bets to say, you know what, I'm going to take some profits. I'm going to get out of these positions because there's no more speculative juice to squeeze. And that may give you a further extension on the moves that we've seen so far last week and going into this week. A weaker dollar, weaker bond yields, and stronger bonds, not because the reflation narrative has fundamentally changed. Arguably, it has not. But because in the immediate term, the incremental dollar isn't looking to chase it, whereas the incremental dollar already invested is maybe looking for an exit because momentum has been sapped. And that may well be activated if the jobs report passes without too much fireworks. That's macro money for today and for this week. We're here Monday through Thursday, so we'll be back next week to keep the conversation going. I am here as ever after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, also Monday through Thursday, looking at the Wall Street close and where things may go therefrom. I'm on with Chris for Futures Power Hour Monday and Friday, so check me there tomorrow as we unpack this jobs report and what it actually meant for markets. I'm also on with Victor Jones for First Call with Tom on Sundays and for The Price of Truth on Wednesdays, where we've been having a spirited debate about the merits of crypto. Come and check us debate that again next week because ostensibly we're not done. I'm also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on both the platform formerly known as Twitter and now on Blue Sky as well. Happy trading. Macro Money's back next week.